Welcome to Quick Bite, your fast and friendly Florida insurance up.
Hello, hello, hello. This is Roshonda with the Isom Insurance Group here in the Sunshine State of Florida. We've got a new Quick Bite episode, your fast and informative insurance market update. Today is Tuesday, October 28th, 2025, and we're tackling something many people avoid, but everyone needs to understand: life insurance. Because if someone depends on you financially, your spouse, your kids, maybe even your parents, you need to know how this works. So let's break down the Yahoo Personal Finance Guide to Life Insurance by Robin Hartill and make it simple: what it is, how it works, and how to decide how much you really need. Let's get into it. Let's get started with the basics. Life insurance is a contract. You pay the insurance company a premium, and in exchange, they agree to pay your beneficiaries a lump sum of money when you die. It sounds simple, but the details make all the difference. Here are a few key terms. The policyholder is the person who owns the policy. The insured is whose life is being covered. The beneficiary is who gets the money. And the premium is what you pay to keep it active. According to Lemur, about 102 million Americans either don't have life insurance or don't have enough coverage. That's roughly 40% of the adult population without a financial safety net for their family. So if that's you, you're not alone. But let's change that today. So, why does life insurance matter so much? Because no one plans to die early, but we can plan to protect the people we leave behind. Let's look at some numbers. The National Funeral Directors Association reports that the average funeral with a viewing and burial cost is $7,848. Add medical bills, mortgage payments, or college tuition, that loss can become a financial earthquake. Life insurance steps in to help your family pay for final expenses and funeral costs, replacing your income, paying off a mortgage or other debts, funding college for your children, or leaving a legacy, maybe a donation to a cause you care about. So really, life insurance isn't about dying, it's about keeping life going for the people you love. Now, let's talk about the two main types of life insurance: term and permanent. Term life insurance, think of term life insurance like a rental contract. You pay for coverage for a set term, 10, 20, or 30 years. If you die during that term, your beneficiary gets the payout. If you outlive the term, the policy ends. Most of the time the policy doesn't just end. It just means that the premium is usually locked in. Some policies will end, but there are some that'll just lock in the premium for that standard term, and then after that term period, say it's like 10 years, the premium just increases and keeps increasing until a lot of times it becomes unaffordable to keep the policy. But a lot of times the policy doesn't just end. With term, there is no cash value, no refund, but it's affordable and straightforward. A healthy 35-year-old can often get a $500,000 term policy for around $25 a month. That's less than most people spend on coffee runs each week. Permanent life insurance. Permanent life insurance is more like buying a home. It covers you for your entire life, includes cash value component that grows over time. Within this category, there are three major types: whole life, which is fixed premiums guaranteeing growth, and a death benefit that never expires; universal life, which is flexible premiums and death benefits that can adjust with your budget; variable life lets you invest part of the policy in sub accounts similar to mutual funds. But remember, the more features, the higher the premium. Rule of thumb: use term life to protect income and debts, and use permanent life for legacy and long term planning. Here's what happens behind the curtain. When you apply for life insurance, the company reviews your age, health, and lifestyle. That's called underwriting. They might request medical records or a short exam. Your monthly premium gets split three ways: operating costs for the insurer, the cost of your actual coverage, and if it's a permanent policy, part goes into your cash value account. That cash value grows tax deferred, and you can borrow against it later for retirement or emergencies. But there's a catch: miss too many payments or borrow too much, and the policy can lapse. And if it lapses, that safety net disappears. Now, the big question: how much coverage is enough? There isn't one perfect answer, but there are a few helpful formulas. The multiple of income method: multiply your annual income by the number of years you want to replace it. If you make $60,000 and want 20 years of protection, you need about 1.2 million in coverage. 10 times income. The next method is 10 times income plus college costs. A popular shortcut: take your income times 10 and add 100 to 150,000 per child for college tuition. Another formula is called the dime. I like the dime formula. I kind of like using that formula when I'm doing a needs analysis for a customer. And dime stands for debt, income, mortgage, and education. Add those numbers up to see how much protection your family would need if you weren't around. Here's a quick example: 50,000 in debt plus 600,000 for income replacement plus 200,000 left on your mortgage plus 150,000 for college equals $1 million policy. That's the kind of coverage that keeps your family financially stable no matter what. So, how do you actually buy life insurance? Step one: decide what type you want, term or permanent, and how much coverage you need. Just let me stop on this. Sometimes you need both. Sometimes it's good in your portfolio to have a term policy and a permanent policy. So, for example, you have really young kids, and if something was to happen to you tomorrow, their needs at a younger age is a lot more. So, you need to get a lot more coverage for a little bit cheaper. So, a term policy would be good for that. And also getting a permanent policy to lock in any type of final expenses that you need when, who knows, way down the road. And that coverage, you always have that coverage. When your kids get older, you don't need as much coverage to cover for them. So, that term can taper off and you can kind of let that term go away, but keeping that permanent policy is definitely for your final expense coverage. Step two: get a quote through a licensed agent. We'll answer some basic questions we'll ask you some basic questions about your health and lifestyle. That's a part of the underwriting process. Step three: complete the application. Most companies will order medical records or even a brief exam, like they'll send a nurse out to do a brief exam depending on how much coverage you're getting. Step four: once approved, review the policy carefully and make sure your first payment has been made. Then you're covered. Quick tip: the younger and healthier you are, the cheaper the rate. In fact, a 40-year-old pays about 60% more than a 30-year-old for the same policy. So if you're thinking about coverage, don't wait. It's always better to go ahead and lock in that coverage. The younger you are, the healthier you are, so you don't get any type of extra surcharge rating based on different medical conditions that can come into play when you get older. So always try to get and lock in as much coverage as possible when you're younger. Here's the bottom line: if anyone depends on your income, you need life insurance. That includes young families, single parents, and even stay-at-home parents. According to care.com, replacing the work of a stay-at-home parent can cost over $40,000 a year. So even if you don't bring home a paycheck, your contribution has real value. The truth is, the best time to buy life insurance is before you think you need it, because once you do need it, it's too late to apply. If you found this quick bite helpful, please like this video, share it with friends, and drop a comment below with any insurance industry questions you'll like for me to cover in a future episode. And don't forget, a new quick bite drops Monday through Friday at 2 p.m. Eastern. This video is for educational purposes only and should not be taken as legal, tax, or specific insurance advice. Always consult a licensed insurance professional about your unique situation. This is Roshonda with the Isom Insurance Group here in sunny Florida. Thank you for watching, and I'll see you next time. Stay safe out there. Bye.
Thank you for watching. Visit us at isominsurancegroup.com.